Hello and welcome back to Dukascopy TV. Now, the Australian resources industry has been in the headlines a lot of late. Joining me in the studio now is Vince Pisani of Shaw Stockbroking to discuss this further. Vince, thank you very much for coming in today. Now, are the Australian iron ore and coaling industries still competitive on a global market?
Well, what we've seen in the last probably 3 or 4 years has been a massive increase in labour costs. We've seen a huge increase, probably 20 to 30% increase in capital costs. And I think the one thing that has probably made it less competitive than what it was maybe 4 to 5, 6 years ago is an influx of new taxes that have come in, such as the mining resource rent tax. We've had carbon taxes being introduced, and we already have a fairly high tax rate compared to a lot of international or overseas countries anyway. Competitive, I would say we've lost our competitive feel in Australia, and we've seen, especially in the last probably 6 months, a number of huge resource projects pulled by the bigger Australian companies simply because capital and operating costs are way too high. So I would say we've lost our competitive position, especially also when you consider the great amount of new discoveries made in Mongolia on copper, on coal. The African nations are really progressing their iron ore and coal industries, and the flow of capital now doesn't have to be in Australia anymore. So we've kind of missed that opportunity to keep ourselves competitive against some of the newer emerging regions where capital can easily flow.
If we look at the uranium markets at present, there's been sort of a lot of conversation surrounding this, the latest being that Queensland have now lifted their ban on uranium marketing. What's the corporate industry saying about uranium prices for the future? Well,
it's quite interesting. Pre-Fukushima, the average valuations made for a lot of the corporate transactions in the market were less than $4 a pound of uranium in the ground. Post-Fukushima, you would have thought at least a halving, because we've had Japan stop uranium production. We've had Germany say that we're going to be closing our uranium industry, over the next 10 years. But what's happened in reality, the corporate world has actually paid double, nearly $8 a pound in the ground compared to under $4 previously. So the corporates have taken the opportunity post-Fukushima to really stamp their authority on some of the great uranium deposits of the world. But funnily enough, Natalie, uranium stocks in the market are following just the basic uranium price, which has fallen from mid-50s to low 40s. So all of the valuations for our key uranium stocks globally, not only in Australia but overseas, have come down. With respect to the lifting of the uranium ban on exploration in Queensland, this was a policy that the Queensland government, the Liberal government, had said prior to the elections that they would lift that. We've seen the West Australian government lift the ban on uranium. We're starting to see the first new leases being given out, and more importantly, we've just had Cameco of Canada come in and make a very large acquisition of a uranium deposit from BHP. We've had the Indian government express a very big interest in terms of doing business with us in uranium. So Queensland lifting its ban, West Australia lifting the ban. We already have a vibrant industry in South Australia for uranium. That's where the traditional BHP Roxby Downs is. I think you'll see a huge amount of new corporate undertakings by overseas companies with respect to deposits in Queensland, West Australia, South Australia now, and that's, I think, the most important thing that's happened over the last week while I've been away here in Europe.
We touched on competitiveness earlier, and with regards to LNG, are the US and Canada are they taking that market away from Australia at present?
Well, over the next couple of years, no. The LNG market, as you know, relies on very, very long-term contracts, in some cases between 20 and 30-year contracts. And really, you don't sign a contract today unless you can start delivering in probably 2 to 3 years from now. Now, both the Canadian and the US market because of the great success they've had in shale oil discoveries and production, have an overabundance of gas. So it makes sense for them to really move the whole domestic gas consumption into an export-orientated ability. Now we've heard from the Canadian government that they want to develop, an Alaskan, property, something like $60 to $65 billion new investment in LNG, but it's a 2020 proposition. The Chinese demand for liquefied natural gas, Korea and Japan are still going to be reliant on Australia, very much so, over the next 4 to 5 years. Maybe by 2017, the first of the major contracts with Canada and America may be signed, but it won't be until 2020 that they'll at least be able to deliver.
Vince, that brings us on quite nicely now to the Dukascopy question, which we ask all of our guests at the end of each interview. And the Dukascopy question is quite simply, if you had $1 million to invest for 1 year, where would you place it? So if we take a look at the board and we can see your options today, we've got real estate, equity, bonds, gold, cash and oil. Now, I do think I know where you're going to go, but can you tell us, Vince, $1 million for 1 year, where would you place it? Well,
I'd have to say into the oil market. We've seen China take over the mantle as the world's biggest energy consumer. It's still growing at 7%, maybe 6.5%, 7%. But in terms of energy consumption, it's actually about a 50% premium to their GDP. So if GDP, is 7%, their energy consumption growth for this year will probably be 10%. Now we're starting to get at least the first inkling of better consumption out of the United States, a small economic recovery. We've got lots more stimulus targeted in areas which will be very energy intensive. India, Indonesia, Africa, and also the Arab states are all starting to see the first levels of economic growth. Unfortunately, Europe isn't, but that's probably going to be a rider into 2013 and 14. So out of all those commodities, I'd have to say oil has the best chance of moving back over like $110 to $120 a barrel, and we've got great oil and gas companies in Australia that people can play.
Great comments, Vince. Thank you very much for coming to the studio, and the best of luck with your roadshow.
Thank you.
For more interviews like this one, stay tuned to Dukascopy TV. For now though, goodbye.